Imagine you're sitting at your kitchen table on a Sunday evening. You've got a stable job, pay your taxes, you've never missed a loan payment in your life. And yet, somehow, you're reading a loan agreement for the third time, trying to figure out exactly when things started to go wrong. Not because you were careless, not because you didn't do your research, but because the loan you signed looked, on the surface, completely legitimate. This video is about that moment, about the financial trap that doesn't announce itself, the one that arrives dressed in professional language, a clean website, and a customer service rep who sounds more reassuring than your own bank. Let's talk about it carefully. Meet David. David is 31 years old. He lives in a mid-sized city. Let's say Columbus, Ohio. Could just as easily be Leeds in England or Lyon in France. The numbers change slightly. The situation doesn't. David works in logistics management. After federal and state taxes, his monthly take-home pay is around $3,800. His rent is $1,150 a month. A decent one-bedroom in a neighborhood that's not glamorous but isn't dangerous either. He has a car payment of $420 a month, a 3-year-old crossover he needed for the commute because public transit in his area is unreliable. He has a student loan from a state university, $290 a month. Still 6 years left on it. His credit card balance sits at around $4,200, not out of recklessness. Medical bills, a car repair, 2 months when work was slow. The minimum payment is $105. He has a phone plan, streaming subscriptions, groceries, utilities. When you add it up honestly, and most people don't, David has roughly $380 to $500 left at the end of each month. Not nothing, but not enough to feel secure. And that gap between what he earns and what he actually feels is exactly where the trap is set. One afternoon, David gets an email. It's not spam. It passed every filter. The domain looks professional. The branding is clean. The language is measured and formal. The subject line reads something like, "Unlock the equity in your assets. Flexible lending for qualified professionals." David reads through it. The company offers what they call a collateral-backed personal loan. The idea sounds straightforward. You own something of value, a car, a savings bond, a small investment account, even certain electronics or jewelry, and you use that as collateral to secure a loan at a lower interest rate than a traditional unsecured personal loan. The logic seems sound. Secured loans are real. Banks do this. Mortgages are secured loans. Auto loans are secured loans. This is not a new concept. The offer says David could access up to $15,000 at 9.4% APR, with 36 monthly payments of roughly $478. For someone carrying credit card debt at 22 to 26% interest, consolidating into a 9.4% secured loan sounds like responsible financial management. David thinks this is actually the smart move. And that thought, that completely reasonable, logically constructed thought, is where the problem begins. Because David hasn't asked the one question that changes everything. Who actually holds the collateral? And what are they legally permitted to do with it? Let's be precise here, because precision matters. A fake collateral loan scheme, sometimes called a collateral fraud arrangement, is not always an obvious scam. That's what makes it dangerous to educated, careful people. In a legitimate secured loan, a licensed financial institution holds a legal lien on your asset. The terms are regulated. The process is transparent. If you default, there is a defined legal procedure that protects both parties. In a fraudulent collateral arrangement, the structure looks identical on the surface, but several critical things are either falsified, misrepresented, or legally unenforceable. Here's how it typically works. A lender, operating through a company that may be registered but not properly licensed as a financial institution, asks you to provide documentation of an asset. This could be your car title, a certificate for a savings account, or proof of ownership of valuables. In some cases, the collateral itself is fabricated. The lender knows it. They're not lending against your asset at all. They're lending you money while creating internal paperwork that makes the loan appear secured, which allows them to charge rates and fees that exceed what unsecured lenders are legally permitted to charge in certain jurisdictions. In other cases, and this is the variant that catches the most professionals, the collateral documentation is real, but the lender's legal authority to hold it or claim it is not. You hand over your car title. The loan agreement contains language buried on page 4 in paragraph 11 in a subordinate clause that grants the company broad rights to transfer, reassign, or, quote, administratively process your collateral documentation upon any payment irregularity. What does administratively process mean? It means nothing legally defined, and that's intentional. The Federal Trade Commission in the United States and the Financial Conduct Authority in the UK have both documented cases where borrowers discovered, only after a missed payment or a billing dispute, that their collateral had been transferred to a third-party debt buyer without their knowledge or consent. The original lender? Often dissolved or restructured by then. The borrower, facing a claim from an entity they've never heard of, backed by documentation they signed without fully understanding. Let's return to David's situation and run the actual numbers. David considers consolidating his $4,200 credit card into a $15,000 collateral loan. The plan is to pay off the card, have some breathing room, and manage one clean monthly payment. On paper, at 9.4% APR over 36 months, his monthly payment is approximately $478. His current minimum credit card payment is $105. But let's be realistic. He was paying around $200 trying to reduce the balance, so the net increase in monthly outflow is around $278. Remember, David has $380 to $500 left at the end of each month. That additional $278 leaves him with $100 to $220 per month. Essentially nothing. No buffer. No savings. One unexpected expense away from a missed payment. And here's where the scheme's real mechanics activate. Most fraudulent collateral loan agreements include penalty clauses for late payment that are written to compound aggressively. A single missed payment, not a default, just one late payment, can trigger what's called an acceleration clause, meaning the entire remaining loan balance becomes due immediately. On a $15,000 loan, 28 months in, that could still mean $8,000 to $10,000 suddenly owed in full. If David can't pay, and statistically someone with $100 of monthly breathing room cannot suddenly produce $10,000, the lender initiates a claim against the collateral. If that collateral is his car title, and the documentation transfer language was buried in that agreement he signed, the car is effectively gone. And without the car, David loses the job that requires it. The math doesn't fail dramatically. It fails quietly, incrementally, and then all at once. David isn't naive. He's educated. He reads, he pays attention. So why does someone like David sign something like this? The answer is not stupidity. The answer is a very well understood psychological state called decision fatigue under financial stress. When a person is managing multiple financial pressures simultaneously, rent, debt, car payments, professional image, social expectations, their capacity for deep analytical reading degrades. This is documented in behavioral economics research going back decades. When you are financially stretched, your brain is not operating in the same deliberate, patient mode it uses when you're comfortable. It is operating in a mode that prioritizes relief, resolution, a way out of the uncomfortable present. And the architects of these schemes understand this deeply. They don't approach people in financial crisis. They approach people in financial friction, people who are managing but barely, people who have enough self-discipline to be responsive to a professional pitch. They use language that triggers confidence, not desperation. Words like qualified professionals, phrases like managing your assets intelligently. The framing says, smart people do this. And because David wants to be smart, because he has spent his adult life trying to be responsible, he reads the offer through the lens of his own self-image. He's not looking for red flags. He's looking for confirmation that this is the right move. That's not a character flaw. That's human cognition operating exactly as it was designed. The financial system, at its worst edges, is engineered around that design. Let's zoom out for a moment. If David walks away from this particular offer, unharmed, a little wiser, and simply continues his current financial trajectory without any change, he's still facing a slow accumulation problem. But that problem is manageable. It has a floor. The student loan ends in 6 years. If he keeps his car for 4 more years and doesn't replace it immediately, his monthly outflow drops significantly. With disciplined credit card repayment, even at $250 a month, that $4,200 balance is gone in under 2 years, with total interest paid around $900. That path is slow. It's not exciting, but it has a destination. The collateral loan path, if it goes wrong, and the structure of these schemes is designed so that a meaningful percentage of borrowers do reach that breaking point, doesn't just set David back financially. It can eliminate the asset that generates his income, damage his credit profile for 7 years, and create a legal dispute with an entity that has more documentation resources than he does. The asymmetry matters. The upside of the scheme is modest, slightly lower interest, temporary breathing room. The downside is structural collapse. Financially intelligent people don't just evaluate the likely outcome. They evaluate the worst-case outcome and ask, can I survive that? In this structure, with this little margin, the answer is no. There's a pattern I notice in people who navigate these years, the 28 to 40 stretch, without accumulating hidden damage. They're not necessarily higher earners. Some of them make less than David. What they share is a specific kind of skepticism toward financial products that appear to solve multiple problems simultaneously. When an offer arrives that seems to consolidate debt, lower interest, and provide extra liquidity all at once, they don't feel relief. They feel curious about what isn't being said. They ask, what does this company earn if I behave exactly as they expect me to? Legitimate lenders earn interest over time. The incentive is for you to repay consistently and remain a customer. When a company's incentive structure, if you read it carefully, earns more when you miss a payment or default, that misalignment is the signal. They also apply a simple personal rule. If I cannot absorb one missed payment without catastrophic consequence, this product has no margin for reality. Life produces unexpected costs, a medical bill, a car repair, a month of reduced hours at work. Any financial commitment that cannot survive one of those events without cascading is a commitment that is structurally too tight for a middle-income life. They also verify licensing. In the United States, legitimate lenders are registered with state financial regulators. The NMLS, Nationwide Multi-State Licensing System, is publicly searchable. In the UK, the FCA register serves the same function. In most EU countries, national banking regulators maintain similar public records. If a lender is not in those databases, the conversation ends there. Not with anger, not with suspicion. Just, this entity does not exist within the regulatory framework that protects me. Therefore, I will not proceed. That's not paranoia. That's basic due diligence dressed up in calm clothing. David's story doesn't end in catastrophe. Not in this version. He takes a few extra days. He searches the company's name on the NMLS database. It's not there. He finds one forum post from someone in a similar city describing a similar offer and a very different outcome. He closes the email. His financial situation doesn't improve that month. The $4,200 card balance is still there. The $290 student loan is still there. The tight margins are still there. But so is the car, and the job, and the credit score. And 6 months later, he calls his actual credit union, a federally insured institution he's had a checking account with for 4 years, and asks about a debt consolidation product. They offer him 14.5% APR, no collateral required, with a 2-year term. It's not as attractive as 9.4% sounded, but it's real. The trap that looks legitimate is not always loud. It doesn't always arrive with broken grammar or suspicious urgency. Sometimes it arrives in clean formatting, calm language, and a promise that sounds exactly like the responsible move. The only reliable protection is knowing what questions to ask before the relief of a solution makes you stop asking them. That's the awareness worth having. Subscribe.